Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good afternoon. Welcome to Midcap Radar. I'm Sumaira Abdi and with me is my colleague Prashant Nair. Prashant, hi. Good afternoon. Well, it's a good day of trade. So from the get-go, the market has been higher. And we've seen positivity through the global markets as well, global currencies. So on account of that, about 270 points higher on the Sensex. But from the high point of trade, we seem to be tapering off just a tad bit actually in the last, half an hour odd. So we're about on the Nifty, about 20 points off of the day's high, but still going strong. And the Midcap index as well in step for now.
Absolutely. And I think, for the week, by the way, the Nifty is going to be up about 30 points if we end off somewhere here. So, I mean, it's not a bad outcome, looking especially at how the first initial part of the week was actually panning out. Ashwani is with us as always on the top of the show. Ashwani, thanks very much. Afternoon, your sense of things now?
There's a bit of come off from the highs, but nothing unusual or nothing very rapid or fast. I would think that even now you can take long positions, and maybe in the next 1.5 hours the market could show you upside. So keep a broad stop about 11,450 on the Nifty futures and maybe 50-70 points lower on the Bank Nifty futures. My sense is that given the way the constituents of Bank Nifty are moving, FMCG is up, pharma is higher, metals is up, there could be a resumption of the rally which could take the Nifty and the Bank Nifty to the highs of the day. So that way, no point shorting. I think it's only a matter of time, whether it's today evening or Monday morning when you get to fresh highs. My sense is still long positions should be maintained and even taken. Having said that, individual stocks, Edelweiss is a buy with a stop of 288, target of 302. Dabur is a buy with a stop of 445, target of 470. And Tata Motors is a buy with a stop of 250, target of 268.
Tata Motors is coming back into, some action, 2.5% higher. Ashwani, the ICICI Bank trade that you put out at 11:30 still stays, holds?
Yeah. See, corporate banking theme is continuing to play out, and almost all corporate banks are today higher. So definitely till that theme continues to play, ICICI Bank is likely to be one of the leaders.
All right, Ashwani, thanks very much for joining in. Let's in fact focus on the global space because there's quite a bit happening on the trade front. US and China will hold a fresh round of talks. We also have, of course, the Turkish crisis. There's the currencies that are taking a beating. And of course, oil always remain in the forefront. There's a strengthening dollar as well. Bruno Verstrate of Lakefield Partners joins in to make sense of all these many, many variables. Bruno, hi. Good morning to you. What's the sense you're getting now? Which of these many factors is actually going to take center stage through the next week? I mean, what's it that you'd have your eye on?
Well, there's a few things that we keep an eye on. First and foremost, I think, is the economic development and also the leading indicators. There we clearly see a deviation from Europe and the rest of the world, where Europe is clearly turning more negative than what one expected. Clearly, Brexit is an issue in Europe that needs to be kept an eye on how that will evolve and what the impact will be on the economies in Europe. The second issue is, of course, how are the other economies evolving? There we see clearly the Asian markets in a good shape. The U.S. is clearly slowing down a little bit, but still growing quite solidly. What could happen is that there is overstimulus in the U.S. in the current state of the economy, which could make the central banks make policy mistakes. And that's what we are clearly keeping an eye on. Inflation is a very important indicator. Also in the light of the tariffs, which are clearly inflationary in the U.S., it could mean that the rates in the U.S. will move up much faster and in the end will slow down the economy, potentially causing it to go into a recession in the medium term.
Mm-hmm. Right, Bruno. I mean, but as things stand right now, what is your view? I mean, are we in a nice sort of a cruise mode type of sort of risk-on mode for financial markets. I mean, dollars seems to be in some retreat. There is thaw between US and China as far as trade is concerned. For the first time since talks broke down in June, officials are meeting. Turkey seems to be on the mend, the currency that is. So for now, it looks that risk-on may continue for a bit longer.
We are indeed still quite bullish on equity. We actually increased our equity exposure in the last rebalancing up to 57%, which is still balanced. It's clear that it's the choice between two bad things somehow. You know that the markets are extending itself. You know the economic growth is at historic long levels. At the same time, the alternative, bonds, is not a place where you want to go to. So we still see a bit of big rotation taking place between bonds and equity. So I don't think the equity rally is over yet. What one needs to consider is how long are you going to stay in cyclical stocks rather than moving into the defensive stocks. And that is a move that we will see eventually. It's slowly but surely starting to take place, but I think it's still a bit too early. And in the meantime, I think some sectors will clearly benefit from a couple of things taking place, such as technology is still a good place to be at. They have a lot of cash, high profit margins, growth is still intact, and I think that's still a good place to keep your money.
Just one last point, Bruno. Do you, in your strategies which you offer clients, etc., do you own gold essentially for your clients?
If we own bonds?
Gold, sorry.
No, we don't. Actually, we only own a derivative of gold, which would be the mining sector, okay. Which at this stage we don't have in the portfolios.
All right, fair enough. Mining stocks. Thanks very much, Bruno. Appreciate you joining in and for those quick comments. Appreciate your time. Okay, so that is some global opinion coming through. We're going to take a very quick break here. 83 points in the Nifty, so there is some more pickup which is happening. So from the time that we started at 130, the Nifty is put on about 10 more points or so. With us here on Midcap Radar, well, the market is still going strong. 80, 81 odd points or so is what we have. Intrasoft Technologies reported numbers. The numbers are pretty poor. The stock, by the way, is at a 52-week low. So yeah, 251 or so is what is the 52-week low, which is where the stock is actually trading. It's come up a little bit actually from the absolute close. It was down almost 20% or so earlier. 241 is where it trades now. We've got the management joining us to take some questions on the numbers. We have Arvind Kajaria, beg your pardon, Managing Director of the company, now joining us on the phone line. Mr. Kajaria, thank you for your time. Good to have you here. Could you tell us what happened? Because, I mean, the numbers are, quite literally a disaster.
If you just, take a moment to read my press release. So we are going through a transformation as far as the capital profile is concerned. So, we've grown for the 4 years at a CAGR of 70%. And, we felt that is the right time to learn tremendous amount from the operating characteristics of our model. So this, we intend to focus our energies on consolidating our operations and improvement of our cash flows to ensure sustainability as we begin our next growth trajectory. So we remember that, we had built up some inventory last when I spoke to you, and we realized that, there's going to be unless we change working capital profile, there's going to be a requirement of capital as we build the business. And the sources of capital are basically, as we all know, is debt, which we don't want to get into. We remain a zero debt company. And the other was the dilution of capital, which also we don't want to consider because, it impairs returns over a longer period. The best option available to us was to generate operating cash flow. And which is why we've, just slowed down a little, restricted some purchases temporarily from the vendors who are taking longer to negotiate our terms of trade. So as when that happens, you'll see a better cash flow, you'll see a better working capital profile, and we'll be ready for the next phase of growth. So, it's been 4 years, and we thought that this is the right time to make this move.
Fair enough. What is this next phase of growth? I mean, is it some sort of new business? Is it a new vertical? What exactly are you intending to do?
No, nothing is, ma'am. It's just more of the same. It's just like, I'm going to repeat myself. If we had, not focused on the cash flow bit, right, then what was happening is that we were having to invest our own capital in the interim. And the more we grew, the more capital we would require. And, we didn't think it proper to keep on increasing our debt. So what we've done, and I'm just going to repeat myself, is that we've restricted purchases from those vendors that were taking longer to adjust to our new terms of trade, which essentially makes us cash flow positive. So as and when that happens, right, and we're on path, the team on the ground is doing that. So as and when that happens, we'll be back on the growth trajectory, but this time with a better working capital profile, which basically means that the supplier credit days, which is 13, as it goes up, the growth will come back. So, we took this decision because we've grown non-stop for the last 4 years, and we felt...
Mr. Kajaria, one would imagine that something like this would be calibrated, right? It would happen slowly. I mean, any business would do that. It's not a switch on and switch off, right?
No, it's not a switch on and switch off. It's slow only. It's just that, I'm hoping that all the stakeholders realize what we've done. It was a move that was required because, had we gone the earlier way, and I remember you asking me the last time I was on your show, it's not possible to keep on raising debt. It just makes the company a little heavy. So we felt that this is the right time because we've grown, from by 70% CAGR. So this is the right time to take stock of who's with us and who's not, and in terms of trade. It happens in the retail trade. It's a very customary thing. It's just that we decided to do it this quarter.
Okay, so yours is a volume-driven business, right? Could you give us a sense of what is your average realization per order? What are the number of orders that have been shipped in this quarter? And given, through the course of the year, how much could this improve?
So we are down in dollar terms because our business is in the U.S. by approximately 4% if you compare us with the June 17 quarter. So, I don't track the orders because for us it's more top line. But my sense is that the orders would have also come down by a similar amount. To move forward, the business remains very robust. The size of the market remains very large. Our place is between the vendor on the left side and the marketplaces on the right side. But somebody has to fund the growth. And we believe that the vendor now, given our value to them, given the brand that we've created, given the engine we have created, we believe that they should have enough skin in the game, which means that, after investing 4 years of our time building the engine, we believe that it's now time for them to help us grow the business by giving us more credit. So
Mr. Kajaria, some would say that, look at what's happening with the stock price. At a 52-week low for a market which is at an all-time high. Fine, markets do their own thing, but you're also in an extremely vulnerable kind of a position. Nobody disputes the size of what's, as you described it on your right side, which is the marketplaces and the opportunity they have in terms of big consumer demand. But you're in a way what you do is easily replaceable. We had this conversation the last time you were on the show as well. Is that something? How would you like to respond to that? Mr. Kajaria, are you there? Mr. Kajaria? Okay, I think we've lost the line with the management at Intrasoft. It's down about 7% or so. We'll try and connect Mr. Kajaria back on the line. And do we have him? I don't think so, but we'll try to get him back.
But the street is clearly not convinced with the management commentary, because as we speak, the stock is taking a further knock downwards. It's now down about 7.5%. So clearly, this whole plan of consolidation, one can wait and see, but this is an area which has been seeing intense, competition, and that's, I suppose, remains one of their key risks as well. let's shift focus then to the retail sector. Reliance Retail has shown tremendous growth lately and has many plans to gain further scale going forward. Mangala Malu, my colleague, caught up with the CEO of Reliance Retail, Damodar Mal, and discussed the company's growth as well as IPO plans.
In the Reliance Retail avatar of mine, the kick of scaling, where science comes in, where what you have cracked in the 5 pilot stores, how do you say, now I'm ambitious, I'm going to take it to 300?
It's a behemoth. Last year it did revenues of close to around 70,000 crores. This first quarter itself is on 26,000 crores. Even if you remove the fuel as well as Jio SIM cards, it's done about 13,000. Where does this behemoth go from here?
In Reliance system, we say there are no target allocation, there is ambition allocation.
What is your ambition?
No, so the ambition is, are you stretching for what looks out of reach? And when you reach there, the stretches increase. I think that's the DNA. Growth is life is the DNA of Reliance Group. And like I said, as we've got the models right, each of the formats have independently made their mistakes, crafted their model well, and now have earned the ambition. In the context, in the playground in which I play, size is never discussed as something to be worried about.
How big is the Indian modern retail trade right now? 3 years from now, where do you see it? And 3 years from now, where do you see Reliance as a pie, a share of that pie?
So, this is what I learned from one of the global consumer product CEOs. And he said, everybody talks about supermarkets and their ratio, their share in the large metros and small towns and total market. He said the correct way to look at this is you are servicing, as modern trade, you are servicing 60 million plus consumers now in India. And these 60 million consumers on an average have 2.5 times per capita income of India.
Okay.
That makes it as juicy, as interesting a market as say Thailand. And in his words, he said, in Thailand, I have a country head. And I don't have a country head for supermarket India. I think that's the way to approach it. We are significant, and I think with our, especially with the tougher part of supermarket retailing, which is fresh produce, the work that we have done on fruits, vegetables, and fresh foods, we believe we have a significant head start and competitive advantage as the consumer changes. We've never operated in any sector without a significant chunk of the playground for ourselves.
I remember this because, the earlier part of Reliance's retail venture, the Vimals, and the earlier part of Reliance Fresh did not do too well. The second coming, you guys are sure about growth?
Oh yes, like I said, not just us. Everybody made their mistakes. Everybody learned. We are first generation. All of us supermarket wallas in the market today, we might be coming from big industrial houses and business houses, but we are first generation supermarket wallas. Everybody has made their mistake, learned their model, and
so now they're all
stronger.
In it to win it.
So now it's about appetite and ambition that the customer, Indian consumer has always been ready. Okay. We have to get our house right, and we are very confident in all parts of Reliance retail business, including our fashion and digital business, that we got our act right. Now is the time to change gear and move forward.